Well, my next guest says the answer lies in emerging market debt. Sara Zervos is the head of the global debt team at OppenheimerFunds, where she oversees $23 billion in international debt, almost half of which is concentrated in emerging markets. And she joins us now here in the studio. And fast forward, welcome. Great to have you, Sara. So emerging markets, a lot of bulls out there, particularly on the equity side of things. But as we watch events in Europe play out on the debt side, is that having an impact on spreads in the emerging markets?
Sure. I mean, in emerging market bonds, there are two types of bonds that we look at. One is external debt issued in dollar-denominated debt by emerging market issuers, and the other is local currency debt. We haven't seen a lot of volatility in the credit product, that dollar debt, but we are seeing a lot of volatility in the currencies.
And what type of debt are you looking at typically when you're looking at emerging markets overall? Do you prefer the sovereign debt, or are there specific corporates that you really like?
We like both. As this year has been ongoing economic recovery on the global side, credit has been doing very well. And in that sense, we do favor corporate bonds because the balance sheets in the corporates of emerging markets are even better than those in the developed world, which are very good. Though the bulk of our exposure is actually in local currency bonds issued by the sovereigns, by the countries themselves.
We're going to be talking a little bit more about Brazil because a lot of people waiting for a decision by their central bank. But you like Brazil quite a bit, and they've struggled this year in terms of, it looks like the pendulum swung one way in terms of inflation, and now it might be swinging the other way in terms of slowing growth.
Sure. It's our biggest overweight in the local debt markets, and that's primarily because of value. If you look at the yield curve in Brazil, regardless of what goes on in the front end, the central bank is pretty credible at targeting inflation in the longer term. And so when you get a yield of 11 to 12.5% on a 7 to 10 year bond, we consider that very, very good value.
You also like Mexico and Indonesia and South Africa. So a couple of those surprised me.
Yep, all of those have incredible economic fundamentals. So when we are doing our work, we look at credit work, and, the credit dynamics of the country, and we also look at the inflation dynamics. In all those cases, all those countries that you mentioned, there are actually high positive real yields and central banks that have very credible inflation-fighting policies. And they all yield somewhere between, like I said, 6% on the low end in Mexico's case, up to 11.5%, 12% in Brazil's case. So we love that kind of value.
Now, debt markets here in the U.S. have had a tough time, unless you're U.S. Treasuries, ironically, right, because of the downgrade. But high-yield debt has really been hit hard in August. We've seen the leveraged loan market also hit pretty hard. And we've just seen gold go through the roof, right, and the Swiss franc as well. Is that having a big impact on fund flows to emerging market funds?
Interestingly, flows into emerging market debt have been pretty consistently positive for several years running. We had one small blip where 1 week there is some outflows in external debt, but they have been positive and steady in the local currency world. And it's really because it's a new regime for emerging markets, which is the values there, the good fundamentals are there. It's a relatively small owned asset class relative to the world of institutional investors. And when you look at even the 3 to 5 to 10 year horizon in emerging markets, the story is fabulous. So that's why we think even those small bits of volatility that come through from major markets are very having a low dent on the flows that we see.
How does that impact the type of credit quality you look at?
Well, we tend to prefer to do detailed work on the interesting stories, which tend to be higher yielding ones or lower credit quality guys. So by doing that, detailed bottom-up analysis, we can find those gems in the different countries, and they tend to not really react to the global story so much. It's more of a company-specific angle.
I have to ask you very quickly, we've got 10 seconds here. Ireland, is that a country that you're looking closely at for opportunities at this point?
Well, in our international bond fund at Oppenheimer, Ireland's within the realm of possibilities. The story seems to be improving, but right now we think that the risk-reward in Europe is not so good.
All right, Sara, got to leave it there. Appreciate you joining us. Interesting look into the emerging market debt markets. Sara Zervos of OppenheimerFunds.